Just imagine for a second that you lost $300,000 due to a glitch. Well, that's what happened to a poor sap this past week. Let's find out what really happened. Welcome to Crypto Saver. So there was a user that decided to implement a delta neutral farming strategy on Mirror. Now, for many of you, this may not seem like a new strategy. I've made a few videos about it. I'll even throw up a card over here. And the general premise is that you go short an M asset, a synthetic asset. You go long that same synthetic asset, right? You have no price exposure and you simply collect the Mirror rewards in the process, right? Well, this guy in particular, he had $1 million worth of SPY shorts. Well, more specifically, mSPY shorts. And this is what happened. So this post was posted on the forum for Mirror and 7 days ago. And as he says here, at 9:53 p.m. UTC time, January 3rd, all of a sudden, the Oracle price for SPY went from 477 to 496. And this was happening during the post or pre-market hours for SPY. Now, as we know, SPY is an ETF, and that is a substantial move for SPY. I'm not even sure SPY has even hit, as a matter of fact, 496 at all altogether. I mean, yeah, even if we look at the charts, I mean, just the daily chart here, right? If the daily closes, I mean, SPY hasn't even gone above 420. So yes, naturally, it going to 496 is a pretty crazy move. Well, this 4% move in the share price of SPY caused him to get liquidated on his short SPY positions. Now, at first, when I read this, I was like, the Oracle must have failed, right? Because they usually use an Oracle. And as it says here, they use band protocols Oracle to basically get the price from the market, right? So when you're trading, the way that Mirror is able to figure out what the price of SPY is at this moment, they pull that price using band's Oracle. Originally, I thought, there must have been a problem with the Oracle because we've seen this. We've even seen this with Anchor when they had some liquidations occur a couple of weeks ago. It was either BETH or BLUNA, but a bunch of people got liquidated because the Oracle price was wrong. I thought the same situation happened here too, but that actually wasn't the case. Because as we look here, he does say, again, the person who lost 300,000, he does say that price is reported in pre-post market hours from at least 19 exchanges in TradeFi, traditional finance. That specific 496.36 price was reported by FINRA and NYSE. And there was a trade executed at that price at 496.361. This execution led to data providers reporting the price to Band protocol as valid prices, right? So we got this price from NYSE, this trade that went for that 496 price. That price was reported to Band protocol. Likely Band has some sort of API that they pay for to receive that type of information. Band protocol takes that and shoots that over to Mirror. Mirror updates their prices and says, wait a minute, we got a guy over here that's supposed to be liquidated at this price, and he gets liquidated at that price. Now, when you get liquidated in DeFi, the way it typically occurs, you usually lose a whole bunch of your collateral because Mirror is essentially waiting for someone else to look at the smart contract to see that, hey, this person needs to be liquidated. And if they come in and they give Mirror that UST that they gave this person for shorting mSPY, because when you short mSPY, you have to first borrow that share, right? Be able to sell it. That's how a short position works. Well, Mirror simply wants their UST back, and they're willing to have someone else give it to them back, and they will actually give you a percentage in return. And that person who facilitates this whole process, the liquidators, they end up making that extra money they make on top. That's profit for their pockets. So in this case, this guy could have lost, let's say, up to 30% of his collateral to the liquidator. That's the profit that the liquidator pockets in his money for helping Mirror get their money back. Now, likely the liquidation didn't occur at 30% because likely this person just actually lost out on their short position. That not only did they lose on a liquidation, but if let's say they shorted SPY at 470 and they get liquidated at 496, and obviously they lost money for every single share that they were short. So the loss on the short position plus the loss on liquidation totals 300,000. Now I tried to dive in and actually see if I could find those orders myself within Think or Swim. It's a trading platform by Ameritrade, and I wasn't able to find it myself. Now he does say that it was reported by one exchange out of all of them out there. And here's the weird thing about it. So either in pre or post market trading, you can never place a market order. You can never do that. You can only place a limit order. And the way a limit order works, you basically say, I want to be filled at X price or better, right? That's the keyword, or better. You can't go out of your way to really overpay for a stock by placing a limit order, because if there's already sell orders out there for a better price, you'll be filled at that better price. And SPY, as we know it, it's the most liquid name that there is. It doesn't matter at what time it's trading, it's a very liquid name. And during that time, there were orders being exchanged at 470. So it's clear that that one single order that went through is basically a glitch. And we've kind of seen that. If you ever kind of bring up a chart in the after hours for a random stock, you can kind of sometimes all of a sudden see a big print that the stock is up like 30-40%, but it's obviously a glitch. That order was either delayed, it didn't get printed at the right time. I mean, in this case, we actually can see SPY was never at that price, so the whole delay thing doesn't really make sense here. But obviously, there was a big mistake there, because even a limit order would not be filled there on such a liquid name. Now, someone else in the same discussion did say that a few months ago, that there was a series of synthetic BABA liquidations due to an overnight ticker print of 7% over prior future price. So same thing there. There was a print of a single trade somewhere out there of BABA, 7% higher than what it should be. The band, Oracle, picks that up, gives it over to Mirror. Mirror sees it, liquidates people out of their position, just like that. And when you get liquidated, so when you have a short position on Mirror, you do not get liquidated based upon what the trading price is of that synthetic asset on Terra. You get liquidated based on what the Oracle price of that asset is. So just to easily explain that, if we bring up the Mirror protocol here, this is kind of the front end for those that are looking to trade it. We can kind of see how mSPY is at 469. This would be the Terra price of mSPY, and this would be the Oracle price. The Oracle price should match the actual price of that asset on the actual stock market, okay? Naturally, most assets in Terra do trade for a premium also. We can kind of see it's trading for 469 versus 467. So you do not get liquidated on the Terra price, you get liquidated on the Oracle price when it comes to Mirror. And in both instances of mSPY for this person and for mBABA for other people a few months ago, it occurred because of the Oracle price, which ultimately is getting pulled from the stock market. So there's a print on the stock market that is causing these people to be liquidated just like that. You know, the guy does mention right here that before this print occurred, his collateral was sitting at 134%. And the minimum collateral for mSPY is at 130%. So it's clear he was really waiting to the last moment to manage that short position. Had he created a buffer before the fact, right, instead of being 134% collateral value, if he either reduced the short position or added more collateral to his short position, he would have been able to kind of sustain that misprint for the time being. But because he was so close to being liquidated, that 4% spike that SPY had was enough to just get him right out of that position. Now, there was a proposal sent over, being voted on right now on Mirror, specifically on this case. Community fund request for unfair liquidation losses, right? And this is referencing that discussion that we were just looking at. Obviously, to try to make the person full again, right? The $300,000 that he lost, hey, let's see if the community can come around and pull together some funds and get this guy back his 300 grand. Well, let's take a look at the poll results so far. If we scroll a little lower, overwhelmingly, it's being voted as no. So unfortunately for this guy, it does not seem like he will be reimbursed those funds. And I would imagine if it was an issue with the actual oracle, people would be more likely to vote yes. I would also imagine that maybe if it was someone with less money, even, right? I mean, some people are looking at this and saying this guy had $1 million short mSPY, $1 million short mSPY, right? Obviously, some people have a grudge and say, well, this guy has enough money as it is, right? If he has enough that he can essentially trust a project that's been out for a year and drop 1 million on one specific trade on one side, he can essentially, eat that loss. It shouldn't be an issue. At least that's how the community is voting on it right now. Now, he did say that the team kind of looked at this and said, okay, we should look into a different approach as to how we treat these liquidations. And I think that's a fair thing. I think looking at a single print on the stock market and using that as the actual oracle price may not be the best approach, because these glitches will continue to happen on the stock market. So moving forward, there will be more people such as himself, and there could have been other people in the past that haven't gone publicly and said, hey, this happened to me, because some of them may not even be aware of what happened to them. So it does make sense that maybe there has to be something else used. So maybe you don't just look at a single trade, maybe you look at the last 20 trades that occurred to figure out the average price, instead of just looking at the last print, things like that. It does suck for the guy, truth be said. 300,000, it's a lot of money. Whoever liquidated him, I mean, made a boatload in return. That's for sure. But I think the biggest lesson that we can take from this, if you are utilizing a delta neutral strategy within mirror, or even if you're just shorting M assets on mirror, the biggest thing you can take from this is create a buffer with your collateral ratio. Do not wait to the very last second. Do not think, well, I'm in this ETF or I'm in this stock and I have this much buffer. It's fine. I'm awake for the next 8 hours. A misprint will completely ruin you, as we saw in this case. Now, if you enjoyed this quick video on what really occurred here, I'd appreciate a like. If you like Terra-related content, make sure to subscribe. I do have a Discord. It's completely free for those of you that kind of want to get in contact with me and so on, and just talk in my little community. Other than that, thank you for watching, and have a great day.